Fixed income cash flow structures. A South African mining company, Platinum Mines Limited, plans to issue bonds to finance a new mining project. Investors are concerned about the company's ability to repay the debt due to the volatile nature of commodity prices. The company is considering structuring the bonds to address these concerns. Which of the following bond structures would best mitigate the investor's credit risk concerns? A. Issuing zero-coupon bonds with a 10-year maturity. B. Issuing bonds with a sinking fund provision that retires 10% of the principal annually. C. Issuing callable bonds that allow the company to repurchase the bonds at par after 5 years. A bond is issued with a coupon schedule that pays 2.5% annually for the first 2 years, 4.0% for the next 3 years, and 6.0% for the final 5 years of its 10-year term. This bond's coupon structure is best described as A. Floating rate note, as the coupon changes over time based on market conditions. B. Deferred coupon bond, as the interest payments are lower in the early years. C. Step-up coupon bond, as the coupon increases by predetermined amounts on specified future dates. An investor is considering purchasing an inflation-linked bond issued by a sovereign government. The bond's prospectus states that its principal value is adjusted semi-annually based on the National Consumer Price Index, CPI, and its coupon payment is calculated by applying a fixed rate to this adjusted principal. This bond is best classified as A. Floating rate note, FRN, as its payments vary with an economic index. B. Capital index bond, as both its principal and coupon payments are adjusted for inflation. C. Interest index bond, as only its coupon payments are linked to an inflation index. The bond structure, sinking fund, directly to the investor's core concern, credit risk. Mandatory principal reduction is the key mechanism that systematically lowers liability and reduces default risk. Zero-coupon bonds increase credit risk by deferring all principal to maturity, while callable bonds benefit the issuer. Neither addresses investors' credit concerns. The core takeaway is that principal reduction over time mitigates credit risk, while deferred repayment increases and issuer flexibility ignores it. Mandatory principal amortization, it actively reduces credit risk, unlike structures that defer payment or prioritize issuer flexibility. Step-up coupon bonds, C, defined by coupon increases at predetermined dates on a fixed schedule, not tied to market conditions. Floating rate notes, A, coupons vary with the market reference rate plus a spread, so they depend on external conditions. Deferred coupon bonds, B, pay no interest at all during the initial years, unlike the bond described which pays 2.5% immediately. The bond is a step-up coupon bond because its coupon changes are preset and scheduled, distinguishing it from floating rate and deferred coupon bonds. The classification hinges on why the coupon changes, preset schedule, step up, market rates, floating, or initial delay, deferred. Capital index bonds, B, both principal and coupon payments are adjusted for inflation, protecting investors against inflation risk. Floating rate notes, A, coupons reset based on market interest rates, but principal stays fixed, so they are not inflation-linked. Interest index bonds, C, only coupons adjust with inflation, while principal remains unchanged. The defining feature of a capital index bond is that both principal and coupons are inflation-adjusted, unlike floating rate or interest index bonds. Always check what is adjusted and the index used. Principal plus inflation equals capital indexed. Coupon only plus inflation equals interest indexed. Coupon plus market rate equals FRN. Fixed income contingency provisions. Tyra Growth Incorporated, a biotechnology firm, is issuing a 10-year bond at a fixed 5.00% annual coupon. The company's treasury team forecasts that short-term interest rates are likely to decline significantly over the next 3 to 5 years. To provide the company with financial flexibility to act on this forecast, the bond should most likely be issued with A. A step-up coupon feature where the rate increases to 5.50% after 5 years. B. A make-whole call provision exercisable at any time after a 1-year protection period. C. A put provision allowing investors to sell the bond back at par starting in year 3. An investor is analyzing a convertible bond issued by NextGen Robotics. The bond has a par value of $1,000, a conversion price of $50, and the company's common stock is currently trading at $40 per share. The bond's conversion ratio is closest to A. 20.00, B. 25.00, C. 0.04. A company decides to add a put provision to its existing bullet bond, allowing investors to sell the bond back to the issuer at par starting in 3 years. All else equal, the immediate effect of adding this provision would most likely be A. An increase in the bond's yield to compensate the issuer for the added risk. B. A decrease in the bond's market price as the new feature makes it less attractive to hold. C. A decrease in the bond's yield as the feature provides valuable protection to investors. An investor observes 2 bonds from the same issuer with identical coupon rates, maturity, and seniority. Bond M trades at a price of 98.5, while Bond N trades at 101.2. The most likely explanation for this price difference is that Bond M A. is callable while Bond N is putable. B. is putable while Bond N is callable. C. is convertible while Bond N is a standard bullet bond. When compared with an option-free bond, which type of bond most likely offers a lower yield to bondholders? A. Callable bond. B. Putable bond. C. Bond with a sinking fund provision. An embedded option that gives the issuer the flexibility to refinance debt if market interest rates decline is most likely A. Conversion provision. B. Put provision. C. Call provision. A make-whole call provides the issuer with refinancing flexibility when rates fall, while offering investor protection through fair compensation, making it the most balanced and appropriate choice. Step-up coupon, option A, increases coupons later, which raises the issuer's cost of debt, not suitable when rates are expected to decline. Put provision, option C, benefits investors by letting them sell back at par, but exposes the issuer to refinancing risk at higher rates, opposite of Tyra Growth's goal. Both A and C protect investors, not issuers. Only the make-whole call, option B, provides the issuer with refinancing flexibility while still compensating investors fairly. The right provision depends on who needs protection. Issuers expecting falling rates should use a call, make-whole call, while investors expecting rising rates prefer step-up coupons or puts. Align the provision with the issuer's or investor's interest. Call equals issuer benefit, falling rates. Step up or put equals investor benefit, rising rates. Each provision serves a distinct purpose. Make-whole call balances flexibility and fairness. Step up compensates for rising rates. Put boosts confidence in lower quality issuers. The conversion ratio is fixed at issuance, par value divided by conversion price, and does not depend on the current stock price. Conversion ratio is fixed. Conversion value fluctuates with stock price. Attractiveness depends on whether conversion value exceeds par value. Put provision lets investors sell back at par, reducing their risk and making the bond more attractive. Increased attractiveness, which results in higher demand, higher price, lower yield. Yield rises only when risk increases. Here, risk decreases, so yield falls. A put provision lowers investor risk, which raises bond price and correspondingly reduces yield. A put provision adds value to investors, which results in bond price increases, yield decreases. More protection equals lower yield. Investor benefiting features, such as put provisions, sinking funds, reduce risk, make bonds more attractive, which results in higher price, lower yield. Issuer benefiting features, such as call provisions, payment in kind, increase investor risk, make bonds less attractive, which results in lower price, higher yield. Always identify who benefits from the provision. Investor benefit leads to premium pricing and lower yields. Issuer benefit leads to discounts and higher yields. Callable bonds benefit issuers by allowing early redemption when rates fall, but harm investors through reinvestment risk and capped price gains, which results in lower price, higher yield. Putable bonds benefit investors by providing downside protection against rising rates or credit risk, which results in higher price, lower yield. Always identify who benefits. Issuer benefit leads to discounts and higher yields. Investor benefit leads to premiums and lower yields. Option B incorrect. Observed prices contradict the scenario. Putable equals premium, callable equals discount. The prices given reverse that logic. Option C incorrect. Convertible bonds should trade at a premium due to their equity option, so a discount price signals it is not behaving like a true convertible. Identify who benefits from the option. Issuer benefit leads to discounts and higher yields. Investor benefit leads to premiums and lower yields. Price differences in otherwise identical bonds almost always reflect embedded options, so always determine whose side the option favors. A put provision reduces investor risk, increases bond attractiveness, and results in higher price with lower yield. Call provision benefits issuers by allowing refinancing when rates fall, but harms investors, which results in lower prices, higher yields. Sinking fund reduces credit risk but increases reinvestment risk, so its impact on yield is mixed and not consistently lower. Not all provisions clearly reduce yields. Call provisions raise yields, while sinking funds have a mixed effect due to the trade-off between reduced credit risk and increased reinvestment risk. Yield direction follows who benefits. Issuer benefit raises yields, investor benefit lowers yields, and mixed benefits create uncertain yield effects. Call provision benefits the issuer by allowing early redemption and refinancing at lower rates when interest rates fall. Conversion provision benefits investors by giving equity upside, not refinancing flexibility. Put provision benefits investors by offering downside protection, not issuer refinancing. A call provision's defining feature is issuer flexibility to refinance debt at lower rates, which distinguishes it from investor benefiting options like conversion or put provisions. Always identify who benefits from the embedded option. Issuer benefit raises yields, investor benefit lowers yields. Call provisions benefit issuers, which results in lower prices, higher yields. Put provisions benefit investors, which results in higher prices, lower yields. Conversion provisions benefit investors, which results in higher prices, lower yields. legal, regulatory, and tax considerations. Fabric Weld Industries is a U.S.-based corporation that generates significant revenue from manufacturing contracts in Japan. To finance a new production facility near Osaka, the company plans to issue yen-denominated bonds to be sold exclusively to institutional investors in the Japanese domestic bond market. Which of the following best classifies this planned bond issuance? A. The bonds would be classified as domestic bonds as they are being sold to investors in the issuer's home market. B. The bonds would be classified as foreign bonds as a non-domestic issuer is issuing bonds denominated in the local currency for sale in that country. C. The bonds would be classified as Eurobonds as they are issued in a currency different from the issuer's domestic currency. An investor in a country with an original issue discount tax provision buys a 5-year zero-coupon bond at a discount to par value. The investor plans to hold the bond until maturity. At maturity, the investor will most likely A. Recognize a capital gain. B. Face no tax implications. C. Have no capital gain or loss. A Brazilian corporation issues British pound, GBP, denominated bonds that are sold primarily to institutional investors in Singapore through an international syndicate of banks. This bond issuance is best classified as A. Domestic bond as the issuer is using its home currency. B. Foreign bond as the bonds are sold in a country different from the issuers. C. Eurobond as the bonds are issued outside the jurisdiction of any single country in a currency not native to the primary market. Foreign bonds issued in a country's domestic market denominated in that country's currency, but by a foreign issuer. For example, samurai bonds in Japan. Domestic bonds require both issuer and market to be in the same country. Eurobonds, issued internationally outside any single country's jurisdiction. Fabric Weld's yen-denominated bonds sold only in Japan qualify as foreign bonds, since the issuer is U.S.-based but the market is Japan. Classification depends on issuer origin, currency, and market location. Original issue discount, OID. The discount between issue price and par is treated as interest income, not capital gain. Investors must recognize taxable income annually on the prorated discount, even without cash received. The tax basis gradually increases until it equals par at maturity. At maturity, redemption equals adjusted basis, which results in no capital gain or loss. Without OID rules, the discount would be taxed as a capital gain at maturity. With OID rules, the discount is taxed annually as interest income, even without cash received. This annual taxation raises the bond's tax basis to par by maturity, eliminating capital gain or loss. OID provisions shift taxation from a lump sum capital gain at maturity to annual interest accruals, ensuring no capital gain when the bond matures. OID provisions shift taxation from capital gains at maturity to annual interest accruals, eliminating capital gain at redemption. OID rules equals taxed annually as interest, no capital gain at maturity. No OID rules equals taxed at maturity as capital gain. Eurobond equals issued outside any single country's jurisdiction, sold internationally via syndicate, not tied to domestic market of issuer, currency, or investor location. Domestic bonds must be issued in the issuer's home country and denominated in its domestic currency. Foreign bonds must be issued in a host country's domestic market in currency. The Brazilian corporation's issuance in Singapore, denominated in GBP, does not meet either condition. If the bond is not issued in the issuer's home country or currency, as domestic or in the host country's domestic market or currency, as foreign, it cannot be classified as domestic or foreign. Classification depends on issuer, currency, and market location. Same country plus domestic currency equals domestic bond. Foreign issuer plus host currency equals foreign bond. International issuance equals Eurobond.